Hi. Let's learn about understanding liquidity risk in banks and business, with examples. Today, we will talk about liquidity risk, the potential difficulty an entity may face in meeting its short-term financial obligations due to an inability to convert assets into cash without incurring a substantial loss. Liquidity risk refers to the potential difficulty an entity may face in meeting its short-term financial obligations due to an inability to convert assets into cash without incurring a substantial loss. This risk is inherent in both financial institutions and corporations, significantly impacting their operational and financial stability. Market liquidity risk is associated with an entity's inability to execute transactions at prevailing market prices due to insufficient market depth or disruptions. On the other hand, funding liquidity risk pertains to the inability to obtain sufficient funding to meet financial obligations. Funding liquidity risk pertains to the challenges an entity may face in obtaining the necessary funds to meet its short-term financial obligations. Liquidity risk is inherent in banks due to the maturity mismatch between short-term funding and long-term illiquid assets. They are guided by regulatory frameworks like Basel III, which set stringent liquidity standards to ensure financial stability and protect depositor interests. While corporations may face liquidity risk due to the maturity mismatch between long-term assets and short-term liabilities, they operate within a wide array of business models, each bringing its unique set of challenges and intricacies in managing liquidity risk. Let's consider a hypothetical mid-sized manufacturing company, Acme Corporation, which has been in operation for over 2 decades. Acme Corporation has always prided itself on its robust sales and steady cash flow, which have provided a solid financial foundation for its operations. However, a confluence of unexpected events tests Acme Corp's financial mettle. Liquidity risk is a very real threat for individuals in their personal finances, and they can manage it by maintaining a reasonable budget, having an emergency fund, and diversifying their investments. Liquidity risk, market risk, and credit risk are distinct types of financial risks, but they are interrelated. Liquidity risk can have ripple effects across the broader economy. For instance, during a financial crisis, liquidity issues in major financial institutions can lead to a domino effect. Liquidity risk is a factor that banks, corporations, and individuals may encounter when they are unable to meet short-term financial obligations due to insufficient cash or the inability to convert assets into cash without significant loss. The management of this risk is crucial to prevent operational disruptions, financial losses, and in severe cases, insolvency or bankruptcy. The landscape of managing liquidity risk has evolved with digital technologies, offering real-time analytics and automated solutions. Here are 4 key takeaways. 1. Liquidity risk arises when an entity, be it a bank, corporation, or individual, faces difficulty in meeting short-term financial obligations due to a lack of cash or the inability to convert assets into cash without substantial loss. 2. Effective management of liquidity risk includes maintaining a portfolio of liquid assets, rigorous cash flow forecasting, and diversifying funding sources. 3. Banks are guided by robust regulatory frameworks like Basel III, which set stringent liquidity standards to ensure financial stability and protect depositor interests, reflecting a global emphasis on robust liquidity risk management. 4. Unmanaged or poorly managed liquidity risk can lead to operational disruptions, financial losses, and reputational damage. In extreme cases, it can drive an entity towards insolvency or bankruptcy. Hope this would help. Thanks for watching.